Welcome to Stop the Bleeding: How to Escape High-Fee Insurance and Advisor Lock-In. In this video, we will move step by step from confusion to control so you can keep more of your money. First, we will frame the problem with proprietary planning that pushes high commission products. Next, we will tackle whole life insurance traps and how to unwind them safely. Then, we will liberate your investments from high-fee custodians using clean transfers. After that, we will highlight the key exception, why disability insurance can be vital. Finally, we will wrap with a practical, time-bound action plan. Let's begin. Here's our roadmap. First, we will define the problem with proprietary firms and why their incentives can work against you. Second, we will cover Step 1, confronting whole life policies and the safe way to exit. Third, we will demonstrate how to transfer IRAs and brokerage accounts without agonizing phone calls to the old firm. Fourth, we will clarify why disability coverage is a powerful exception worth keeping. Fifth, we will deliver a simple 90-day action plan and checklists. Throughout, you will get quick quizzes to solidify your knowledge. Let's start with a short disclaimer to set expectations. Before we proceed, a brief but important disclaimer. This video is for educational purposes and does not constitute personalized financial, legal, or tax advice. Products and regulations vary by state and by provider. You should consult a fee-only fiduciary advisor and, where applicable, a licensed insurance professional who can evaluate your specific needs, risk tolerance, health, and financial goals. With that in place, let's transition into defining the problem we're solving. Many young professionals report feeling overwhelmed when confronted with layers of accounts and policies sold as comprehensive planning. Often, the plan is a sales funnel into high-commission products like whole life insurance, combined with proprietary, high-fee investment accounts. As a result, you may pay more than necessary and see lackluster growth. To move forward, we will first identify the trap, then present a safe and efficient way out. Next, we will separate insurance for protection from investments for growth. Whole life insurance combines permanent insurance with a forced savings component called cash value. The problem is that this blend often carries heavy commissions and ongoing administrative costs, which drag on your long-term returns. As a result, the cash value typically grows slowly relative to what you could achieve in low-cost diversified investments. Therefore, a core principle is to separate functions. Use insurance strictly for protection and use investment accounts for growth. Next, we will compare term life to whole life so you can see the practical differences. Here is a direct comparison. On the left, term life insurance provides pure protection for a defined period at a relatively low cost. You can shop across carriers and tailor coverage to your income and dependence. Importantly, by paying less for insurance, you can invest the difference in low-cost index funds, which historically support better long-term growth. On the right, whole life mixes insurance with a cash value component. This blend introduces high commissions and various fees, often accompanied by complex illustrations that can obscure realistic expectations. The opportunity cost of locking dollars into a low-yield structure is significant. With this context, let's walk through how to exit whole life safely. This decision flow starts with a crucial question. Do you actually need life insurance right now? If you do not have dependents or large debts, you may conclude that you do not need coverage, making cancellation more straightforward, though you still must confirm surrender charges and any tax implications. If you do need protection, the safe path is to secure an appropriate term life policy first. Once the term policy is approved and in force, you can proceed to cancel the whole life policy directly with the carrier's customer service, while verifying surrender charges and any taxable gains. Finally, you can redeploy freed-up cash toward emergency savings, debt reduction, and low-cost investments. Next, let's turn this into concrete steps. First, apply for term life coverage if you have dependents or major obligations. Second, wait until the new term policy is fully approved and in force. This avoids any coverage gap. Third, once your term is active, contact the whole life carrier's customer service line to initiate cancellation. Fourth, ask for a clear breakdown of surrender charges and whether any taxable gain could appear. Finally, redirect the monthly savings toward your emergency fund, debt payoff, and low-cost diversified investments. Now, to confirm your understanding, let's try a quick quiz. Quiz time. The question is, what is the safest order of operations when exiting a whole life policy if you still need life insurance? Option A, cancel whole life, then apply for term life. Option B, Apply for term life, ensure it's in force, then cancel whole life. Option C. Keep both forever to be safe. Option D. Cancel both and self-insure immediately. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. You should apply for term life, confirm that the policy is in force, and only then cancel your whole life policy. This sequencing protects you from any coverage gap. Now that your insurance foundation is set, let's move on to liberating your investments from high-fee custodians. To escape high-fee investment platforms, open replacement accounts at a major low-cost custodian. Next, initiate an ACAT transfer, which allows the new custodian to electronically pull assets from the old firm. This process reduces the need for you to call the old provider. Then, select broadly diversified, low-fee index funds or ETFs suited to your risk tolerance and time horizon. Finally, disable automatic contributions at the old firm and set up new contributions at your new custodian. To visualize the process flow across institutions, let's look at the transfer sequence. In this sequence, you begin by opening a new account. The new custodian then initiates an ACAT request to the old firm. The old firm validates ownership and either releases assets in kind or liquidates them depending on transfer instructions and asset compatibility. The new custodian receives the assets and places them in your account, after which you confirm positions and set up ongoing contributions. Be aware that some firms charge outbound transfer fees and that the timeline typically ranges from 3 to 10 business days. Now let's convert this into a quick checklist for selecting a low-cost custodian. Use this checklist when evaluating custodians. Focus on low expense ratios for index funds, ideally under 10 basis points. Avoid ongoing account fees that drag on returns. Prioritize zero-commission trading environments for stocks and ETFs, and low or no transaction fees for mutual funds. Confirm that the provider offers the account types you need: Roth IRA, traditional IRA, brokerage, and HSA, if relevant. Finally, ensure their customer support, especially the ACAT transfer desk, is responsive and transparent about timelines and any transfer fees. Next, let's explore the exception to the rule. Disability insurance. Unlike whole life, disability insurance can be invaluable because you are far more likely to suffer a disabling event than to die prematurely during your working years. High-quality, own occupation, non-cancelable, and portable coverage can provide tax-free benefits if premiums are paid with after-tax dollars. Because premiums typically increase with age and health changes, securing a strong policy earlier in your career can be cost-effective. The pie graphic is illustrative to emphasize relative risk, not a precise statistic. Review your existing DI carefully and compare riders, elimination periods, and benefit durations. Now let's test your understanding with a quick quiz. Here is your next quiz. Which disability insurance traits are most valuable for a young professional seeking robust protection? Option A. Employer paid, cancelable, any occupation. Option B. Individually owned, non-cancelable, own occupation, portable. Option C. Shortest elimination period regardless of cost. Option D. Only accidental injury coverage. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The key features: individually owned, non-cancelable, own occupation, and portable emphasize control, stability, and benefits that align with your actual job responsibilities. Employer plans can be helpful, but they may be cancelable or taxable and may not travel with you between jobs. Next, let's turn everything into a practical 90-day plan. This timeline organizes your transition. In days 0 to 14, audit your existing policies and accounts, pause new contributions to the old firm, obtain quotes for term life, and shortlist low-cost custodians. In days 15 to 30, apply for term coverage, open the new IRA, Roth IRA, and brokerage accounts, and prepare ACAT documentation. In days 31 to 60, once term coverage is in force, initiate ACAT transfers and set your asset allocation and new automatic contributions. In days 61 to 90, cancel whole life if appropriate. Confirm that transfers settled correctly, finish building your emergency fund, and finalize any disability insurance riders. This phased approach reduces confusion and keeps momentum. Now, let's consolidate the most important ideas. Here is a concise, Markdown-style checklist you can use to stay organized. First, Price term life coverage at roughly 10 to 15 times income, adjusting for debts and dependents. Second, open low-cost IRA, Roth IRA, and brokerage accounts. Third, submit ACAT transfer requests so that your new custodian pulls assets from the old firm. Fourth, confirm your term policy is active before you cancel any whole life policy. Fifth, review disability insurance to ensure you have own occupation language, non-cancelable provisions, and portability. Next, we'll capture the key points before summarizing. These are the core takeaways. 1. Separate insurance from investments. Insurance protects. Investments grow. 2. If you need protection, secure term life first and only then cancel whole life. 3. Use ACAT transfers to move your accounts to low-cost custodians with minimal friction. 4. Disability insurance is a valuable exception. Emphasize strong, portable coverage. 5. Follow a pragmatic 90-day plan with checkpoints to stay on track. Now, let's summarize and get you moving. In summary, you can exit high-fee traps while maintaining the protection you need. Use ACAT to transfer accounts efficiently. Then, invest the savings in low-cost, diversified funds aligned with your goals. Keep disability insurance strong to protect your income, which is your most valuable asset. Finally, follow the 90-day plan and set a reminder to review annually. As we close, I have one request that helps our community grow. Thank you for watching. If this video helped you, please like it, share it with someone who needs it, and subscribe for more practical money-saving content. I would love to hear your next step in the comments, whether it's pricing term life, initiating an ACAT transfer, or reviewing disability coverage. Your engagement helps others find this resource. See you in the next video.